The preparation of consolidated financial statements requires more than simply combining the financial statements of the parent and its subsidiaries. Under IFRS 10 Consolidated Financial Statements, IFRS 3 Business Combinations, and IAS 28 Investments in Associates and Joint Ventures, consolidation requires numerous adjustments to eliminate transactions occurring within the group and to present the group as a single economic entity. In addition to goodwill and non-controlling interests, the treatment of other components of equity, intragroup transfers of assets, and intragroup dividends plays an important role in ensuring that consolidated financial statements faithfully represent the financial position and performance of the group without overstating assets, profits, or equity. Other components of equity in consolidated financial statements. Equity within consolidated financial statements comprises more than retained earnings and share capital. Various reserves accumulated by the parent and subsidiaries must be appropriately classified and presented. Common other components of equity include share premium, revaluation surplus, foreign currency translation reserve, fair value reserve, other comprehensive income reserves. Only the parent company's share capital and share premium appear in the consolidated statement of financial position because consolidated financial statements present the group from the perspective of the parent company. The subsidiary's share capital and share premium are eliminated during consolidation against the parent's investment in the subsidiary at acquisition. Consequently, the subsidiary's equity existing at acquisition forms part of the identifiable net assets used in calculating goodwill rather than remaining separately presented in consolidated equity. Share premium. Share premium arises when shares are issued above their nominal value. Within consolidated financial statements, only the parent's share premium reserve is presented because shareholders of the subsidiary do not hold shares in the consolidated reporting entity itself. The subsidiary's share premium existing before acquisition is included within the subsidiary's identifiable net assets acquired and therefore contributes indirectly to the calculation of goodwill. Post-acquisition changes in the subsidiary's reserves affect consolidated retained earnings according to ownership interests but do not create separate share premium balances within group equity. This treatment reflects the legal and economic reality that the consolidated entity has only one parent share capital structure. Revaluation surplus. A revaluation surplus arises when non-current assets are measured under the revaluation model permitted by IAS 16. Where the subsidiary possessed a revaluation surplus at acquisition, that balance forms part of the identifiable net assets acquired and therefore influences goodwill calculation. Subsequent increases in revaluation surplus occurring after acquisition represent post-acquisition reserves. The parent's proportionate share contributes to consolidated equity, while the non-controlling interest receives its corresponding allocation where applicable. Since revaluation gains are recognized in other comprehensive income, OCI, rather than profit or loss, they accumulate within equity until realized through disposal or transferred directly to retained earnings where permitted. Appropriate allocation of post-acquisition revaluation movements ensures accurate presentation of consolidated equity. Intragroup transfers of assets. One of the fundamental principles of consolidation is that profits cannot arise from transactions occurring within the group itself. Consequently, intragroup transfers of non-current assets or inventories require elimination adjustments because the group cannot generate economic gains merely by transferring assets between its own companies. If a parent sells an asset to its subsidiary at a profit, the profit recognized in the individual financial statements remains unrealized from the group's perspective because ownership is not transferred outside the economic entity. The unrealized profit must therefore be eliminated during consolidation. Failure to eliminate such gains would overstate consolidated profits and asset carrying amounts. Intragroup transfers of inventories. Inventory transfers frequently generate unrealized profits where inventory remains unsold outside the group at the reporting date. For example, if the parent sells inventory costing $80,000 to its subsidiary for $100,000 and the subsidiary still holds the inventory at year-end, the $20,000 internal profit has not yet been realized by the group. Consolidation therefore requires reduction of inventory by the unrealized profit and reduction of consolidated retained earnings by the same amount. Where the selling entity is the subsidiary, adjustments may also affect the non-controlling interest depending upon ownership percentages. These elimination entries ensure that inventories are reported at their original cost to the group until sold externally. Intragroup transfers of non-current assets. Transfers of property, plant and equipment within the group also require consolidation adjustments. If an asset is sold internally at a profit, the carrying amount recorded by the purchasing entity exceeds the original carrying amount from the group's perspective. The unrealized gain must therefore be eliminated from consolidated profit. Furthermore, depreciation charged by the purchasing company is based on the inflated transfer price. Consolidation consequently requires elimination of the unrealized profit, reduction of the asset carrying amount to original group cost, and adjustment of excess depreciation recognized after the transfer. These adjustments ensure that depreciation and asset values reflect economic reality from the perspective of the consolidated group rather than individual legal entities. Intragroup dividends. Dividends paid between group companies represent internal distributions of group resources and therefore cannot generate income from the perspective of the consolidated entity. Where a subsidiary pays dividends to the parent, dividend income recognized by the parent and dividend distributions recognized by the subsidiary must be eliminated during consolidation. Failure to eliminate intragroup dividends would overstate both group income and dividend distributions despite no economic transaction occurring with external parties. Only dividends paid to non-controlling shareholders remain recognized because these represent genuine distributions outside the parent group's ownership interest. Accordingly, intragroup dividend elimination preserves the integrity of consolidated profit and retained earnings. Financial reporting significance. The accounting treatment of equity reserves, intragroup asset transfers, and intragroup dividends reflects the single economic entity concept that underpins consolidated financial reporting. Share premium and subsidiary equity reserves are appropriately incorporated into goodwill and post-acquisition reserves, while unrealized profits arising from internal transfers are eliminated to prevent overstatement of assets and profits. Similarly, intragroup dividends are removed because they represent internal reallocations of resources rather than external income. Through these consolidation adjustments, IFRS 10 and related standards ensure that consolidated financial statements faithfully represent the financial position and performance of the group as a whole, providing investors, creditors, and other stakeholders with transparent, comparable, and decision-useful information regarding the economic substance of corporate group activities.